So in a exponential asset, much like Amazon stock, which is and Facebook stock, you start early stage of adoption with high volatility because you don't know if it's going to succeed. Are we going to get adoption or not? Then over time, the volatility shrinks, but the rate of increase continues to go higher in that logarithmic exponential trend. So to understand all of this, you just need to put up log charts of everything, and everything looks normal then. Same as it does for Google, Facebook, Amazon, Apple, Tesla, they're all the same. And they're all network effect businesses. Even though you don't know what the network effect of Tesla is, there is network effects that's built into that stock. So now we are down 50%, 2 standard deviations oversold versus that logarithmic trend, which is normally where the market turns around. So this should be normal price action within the trend. So that's telling you should be more leaning forward and saying, okay, I'm looking for the low. Is it here? Is it a bit lower? Blah, blah, blah. And I think we reached that low. Again, it's very much like equities. It's probably 60-40, maybe 70-30 in the case of crypto that we reached that low. So why? What is the next accelerant? Well, we know there's more adoption from institutions, governments, and everything else. What's happening geopolitically is another adoption factor. So that's interesting in itself. Then for sovereign states, particularly sovereign wealth funds, they will look for a long duration asset of which gives them some security, so it has a place. So we will see a further adoption for sovereign states of this, not necessarily as a currency, but as an asset. So I think that is as a reserve asset, I think that's very interesting. I think that's the place of Bitcoin in the world, as a kind of pristine collateral reserve asset. So we've got the sparks in place. The next thing we need is the inflation story to die. That would be a true accelerant, and growth to be falling and the central banks to be printing more money, because it does very well. It drives adoption. It doesn't just drive the price up like it does with equities and gold and real estate. It drives adoption, which is why it always massively outperforms everything else in times of monetary largesse. So you're setting up for a perfect storm here. And that's so the argument, was it going to go lower before, blah, blah, blah. Right now, unlikely. There's a probability of it. Still a decent probability, call it 30%, 35%, but I think unlikely. Let's put the log chart of Bitcoin up. Let's say that's our proxy for the space. Well, the log chart of Bitcoin tells you get to $1 million in not very long. Not very long meaning like 5 years, or whatever the number is, right? Again, it's not forecast per se. It's like by then, but it's the trend of direction. So what must be true for that to happen? Well, a lot of people have to have bought Bitcoin. If a lot of people have bought Bitcoin and Bitcoin is currently losing market share, it means that the whole crypto market has absolutely exploded. So if that were to be true, what would be happening for that to be true? Well, many of these things that we're seeing experiments now are likely to get mass scale adoption. People get overly complex and they miss the big picture because they think it can't be true. Model-based people. And there's that lovely bell curve with the 2 Jedis.
I love that. It's such a good
And it's so true. It's so true in macro. Like I see it all the time with this printing of money. It can't be, it doesn't work that way, blah, blah, blah. I'm like, the evidence is clear that all asset prices are linked to this. The moment you overcomplicate it by looking for the weakness or a particular nuance in it, the moment you will miss everything. Now, that doesn't mean you shouldn't be skeptical of stuff, but you need to go through the process of thinking through the weaknesses and then think, are they so big that they overwhelm the larger? So, big picture, right? We're seeing every single signal you would ever need to see to say this is going to be the predominant architecture of the global financial system and the global system of value and of all digital assets and of all contractual terms, which means it's gigantic and it's only a $2 trillion asset class. And therefore, if it's the same size as any other asset class, it's going to be 200 trillion or 300 trillion. By social tokens, is for me a nice future point, because I could see this is coming, because tokenizing community was the new business model. That was the business model of Web 3, and NFTs don't scale. So you need an organizing set of currencies for this new digital world where we hang out in different communities. So if you are a 12-year-old kid now, the probability of you earning your living by being a participant in the networks, cultural networks, sports stars, sports teams, music, fashion, gaming, and earning equity, a stake in the network, is a game changer. So for all of that to be happening, which is all part of this fourth turning and everything else, therefore social tokens are clearly going to be gigantic. Why would you not, if you were the world's largest pop star, take the intangible of brand and community? Why would you not turn it into a tangible of a token? You're unleashing billions of dollars of value, in fact trillions of dollars when you look at intangible assets on balance sheets of firms, and you're sharing it with your community. Right, it's happening in front of our eyes. People don't understand it yet. I will be trying to explain this to people soon in what this is, but this is a full token economy being built and at reasonable scale.
And it's going to happen much faster, you think, than most people are aware of, as in...
Well, because you're incentivized in tokens. You're incentivized to use the network. So yes, much faster than anybody imagines. You know, what we're talking about is in 2 years' time, you look back and go, oh my God, what happened? You know, and I've spoken to Meta and I've spoken to Google and all of these guys. It's not like they don't know. It's not like they're going, la, 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 I can't hear you. They're going straight into that world too. And it's not, they understand that they can't own that world, but they understand that they've got the eyeballs. And so they want to be part of that world. So it's, you know, the speed of which this will happen is going to shock people. So then you have to argue with yourself, okay, the probability is so high because the incentives are so aligned. What could be true to make it not happen? And I can't find a good reason outside of regulation, but it's going to be very hard to regulate supporters of football clubs. These are average people. You're giving them a chance. You're giving them an asset that they can own, that's not nosebleed valuations, that they can develop and they can help grow. So the political backlash of trying to stop this is too big. So that's what living in the future is about, is for this to be the case, then what must be true for that to happen? So that bond chart, if you live in the future, you extrapolate that trend, you are cognizant of the fact that the trend will break at some point. And maybe, as some people suggest, it just trades sideways and we've had the low. But what it tells you is a lot of things about debt, demographics, disinflationary trends, technology, and therefore you can extrapolate several things going out. You know, the future tells you the probability is that the economy weakens fast and therefore bond yields don't break out. If that is the case, therefore, the ongoing exponential trend in exponential age stocks, i.e. these network effect stocks, will continue because inflation is the only killer of those. And if inflation is not going to be the problem. So it gives you lots of ways of living in the future by extrapolating out with probabilistic frameworks.